There are 58 monthly dividend stocks on the market right now. Some pay yields above 20%. Sounds incredible until the market turns and those payments vanish. Anyone can find a monthly payer. Finding one that actually keeps paying is a completely different problem. In this video, Josh goes through the full list, starting with the stocks that look the best, showing why most of them fail, and narrowing it down to the single best monthly dividend stock you can buy right now. And in the end, I show you how Josh's one monthly dividend stock turns $10 a day into over $800,000, paying out over $3,400 every single month. That number starts with a choice, and the first thing Josh looks at is what everyone looks at, the highest yield on the list. So he checks the top of the list, sorted by yield, highest to lowest. The numbers at the top look extraordinary, 57%, 42%, 31%. Then he checks what's actually behind them. Josh looks at the payout ratio column. That number tells you what percentage of its earnings a company is actually paying out as dividends. Some of these don't even have a payout ratio. There's nothing to measure. And the ones that do? Look at the numbers. 813%, 346%, 244%. A payout ratio above 100% means the company is paying out more than it earns. That's not a dividend. That's a company returning your own capital to you while the business bleeds underneath it. Then there's the yield trap. When a stock price falls, the yield percentage goes up. Not because the company got more generous, but because the denominator got smaller. The highest yields on any list are often just the stocks that have fallen the furthest. The income looked bigger because the investment got smaller. So if yield alone isn't the answer, Josh needs a different starting point. And the starting point is the structure itself. Why monthly dividends specifically, and why this matters more than most people think. Most dividend stocks pay quarterly. 4 times a year, the income hits the account. Monthly payers do it 12 times. That difference sounds cosmetic. It isn't. When dividends are reinvested monthly instead of quarterly, the compounding cycle runs 3 times faster. Every payment buys more shares. Those shares generate more dividends. Those dividends buy more shares again. The gap between a monthly compounder and a quarterly one, same yield, same growth rate, same investment, runs into tens of thousands of dollars. Not because of anything clever, just because the engine turns over more often. That's the structural case for monthly. There's also something specific about right now. The sector that produces most of the strongest monthly dividend stocks, business development companies or BDCs, has been under pressure in 2026. Broader market concerns about private credit, AI disruption risk to software-backed loans, general volatility. The result is that some of the most fundamentally sound monthly payers are trading significantly below where they were 12 months ago. The sector got nervous. The businesses didn't change. That's not a guarantee. Markets can stay nervous longer than anyone expects, but a lower entry point means more shares at a cheaper price early on, and in a compounding model, the early years matter most. Josh narrows the list down and sets 3 rules. If a stock can't clear all 3, it doesn't matter what the yield is. Rule 1. The dividend has to be covered by what the company actually earns. A payout ratio above 100% is an automatic disqualification. Not a yellow flag, a removal. A company paying out more than it makes is not running a dividend, it's running a countdown. Rule 2. The stock has to have paid through at least one major recession without cutting the regular dividend. 2008 and 2020 are the 2 tests. If a company couldn't hold the line when everything was falling apart, Josh doesn't trust it to hold the line for 30 years of normal life either. Rule 3. The dividend has to be growing. A 10% yield that stays flat doesn't keep up with inflation. The income has to expand over time. 10 years of dividend growth history is the minimum. Josh picks up the list and starts cutting. Josh works through the list stock by stock. The top of the list clears itself. NLOP, ECC, SPMC, HRZN. Massive yields, barely any earnings behind them. Some don't even have a payout ratio to measure. They're gone before Josh finishes the first column. Take SCM. Past performance score is 0 out of 6 across every single metric. Shareholder return, down 34% over the past year, while the market was up 16%. That's not a dividend stock. That's a stock returning your capital to you in small monthly installments while the investment collapses underneath it. Further down, a few stocks make him look twice. SBR stays on the list longer. The yield looks strong. Then Josh checks what actually drives the payment. Sabine is a royalty trust. Every distribution is a direct function of what oil sold for that month. There's no stable dividend, no earnings coverage, and no cash flow coverage. Simple Wall Street flags, all three. When crude dropped in 2020, the payout dropped with it. There's no business decision behind the dividend. There's just a commodity price. Cross it off. Realty income gets more respect than anything else on this list. 6 out of 6 on dividends. Every single criteria is green. 669 consecutive monthly dividends. Josh knows the name. Then he checks the one number not on that screen. 10-year share price appreciation is actually negative. The income is perfect. The capital goes nowhere. That gap compounds into a problem. Set it aside. In a couple of minutes, I'll show you which stock Josh picks. And in the end, I'll show you how it turns $10 a day into over $800,000, paying over $3,400 every single month. But first, the next stock on the list takes 30 seconds to eliminate. And it is Glad. Payout ratio of 122%, paying out more than it earns. The gauge is overflowing, down 37% over the past year, while the market was up 16%. Rule 1 fails before Josh finishes reading. Cross it off. CSWC is the last one standing, and it's the hardest call. 11.9% yield, 12% dividend growth over 10 years. Those numbers are better than anything else on this list. Josh almost stops here. Then he pulls up the dividend history. The chart starts in 2016. The entire track record, every number that looks impressive, comes from after a complete business restructuring in 2015. Simple Wall Street flags the payments as volatile. And the one question Josh keeps coming back to, where is the 2008 data? There isn't any. CSWC wasn't running this strategy in 2008, but one stock was. One stock was paying monthly dividends through 2008, through COVID, through every market that tried to force its hand, and never cut once. Main Street Capital. So what is Main Street Capital? It's a BDC, a business development company. That label stops most people. It shouldn't. Here's what it actually means. There are thousands of small and mid-sized private businesses in the United States that need capital to grow, to hire, to acquire, to expand. They're too small for Goldman Sachs, too established for venture capital. The banks want collateral they don't have, so they turn to companies like Main. Main steps in, provides the financing, and charges for it. That's the business. What makes Main different from most BDCs is how it earns. Most BDCs lend money and collect interest, one income stream. Main does that too, but it also takes equity stakes in some of the companies it backs. So when one of those businesses grows and gets sold or goes public, Main captures that upside as well. Interest income on one side, equity gains on the other. Two engines running at the same time. The share price is up over 250% since Main went public and 71% over the past 10 years. That's the equity engine actually showing up in the price. Then Josh checks the track record. The chart goes back to 2007, the year Main went public. The gray bars are the monthly dividends. They go up through 2008, through the recession, through 2020, through COVID. Every single month, the payment went out. The NAV per share line tells the second story, starting at around $12 in 2007, climbing to $34 by 2026. That's the equity engine working alongside the income engine, the two streams Josh identified earlier showing up in the same chart. Main is also internally managed. The people running it are employed directly by the company, not by an outside firm collecting fees off the top. In the BDC space, that's rare. It keeps more of the income where it belongs. And beyond the regular monthly dividend, Main periodically pays supplemental distributions, bonus payments on top of the base. The regular monthly is the floor. The supplementals are everything above it. Josh runs the numbers. An 8.38% yield, dividend growth averaging 3.69% a year over the past decade, and share price appreciation running at 5.12% annually. And that last number is what keeps the whole thing growing underneath the income. Josh isn't going to pretend Main is perfect. That's not how this works. The share price appreciation is 5.12% annually. That's modest. This is not a stock you buy to watch the number go up on your screen every morning. The price has dropped from $67.54 12 months ago to $52.96 today. The BDC sector got nervous about AI disruption risk to software-backed loans, and the price followed the sector down. The business didn't change, but the price did. Wall Street's current consensus on Main is hold, not strong buy. Analysts aren't worried about the dividend. They're debating valuation, whether the stock is expensive relative to book value. That's a different argument from whether the dividend is safe. The coverage ratio is 132%. What this means is that Maine earns $1.32 for every $1 it pays out. The bears are making a valuation argument, not a dividend argument, not a business argument, a valuation argument. Short interest sits at 8.6%. Professional investors are actively betting against it right now. Josh notes it. He doesn't ignore it. But Josh isn't buying Maine for next quarter. He's buying it for the long run. That's the trade-off. Now the question is what it does for you. What does this actually look like if you put $10 a day into Maine over the long run? The starting point is already established. Maine carries a forward dividend yield of 8.38%. That dividend has grown at 3.69% annually over the past 10 years. Over the same period, the share price has appreciated at 5.12% per year. That combination is what the projections are built on. Now, here is what happens when Josh invests $10 a day into Maine. By the end of year 1, he would have invested $3,650 into this monthly dividend stock. By year 10, the portfolio is projected at $66,594 with annual dividend income of $4,119. That's $343 a month. By year 20, the projections show a portfolio valued at $268,816 with an annual dividend income of $15,159 or $1,263 a month. By year 30, the portfolio is projected at $824,858. Annual dividend income hits $40,963. That's $3,414 every single month. Each decade, the jump gets larger. Now, if you want to see what happens when the number gets bigger, what a $100,000 dividend portfolio pays you every single month, that video is on screen right now.